financial markets. Now, this most of the time can be a bit of a problem for a newbie because, first and foremost, the market has a lot of information that it's throwing at you per second. And if you're not very structured in the way you process that information, you could get lost in the whole process, which means you can get confused by the barrage of information that is, rushing at you. And most of the time, like I've always said, we develop biases and, our own agenda when we most of the time go to the charts. And my job this evening is to help you, first of all, understand what reading the financial markets means. That's what does it mean to read the market? What does it mean to try and understand what the market is doing so that you can prepare yourself accordingly? Yes, because once you understand what the market is doing, it becomes a lot easier for you to go and be in that flow, right? So I'll try and use to explain some concepts and then try and use the live chat to show you some of the things that I am trying to help you understand. Okay? Are we together? All right. So,
Yes, boss.
all right. So I may not be seeing anybody because I'm at the board, so I can't see anybody. I don't know anything. So just try and follow as I try to explain this as simply as possible for you to understand. Now, first and foremost, before you begin your journey to understanding or reading the financial markets, you need to understand that every market operates on literally the same principles. So whatever you learn, whenever you're learning your technical analysis and other types of analysis, the same principles apply across markets, whether it is indices, whether it is forex, whether it is stock, whether it is crypto, all the same principles apply. Yes, and these things have been in existence for years, even though from time to time people are developing newer ways to look at the market. One of the oldest way of course of reading the financial markets is what we all know as technical analysis. Yes, popularly known as TA. Don't mind my doctor's writing. I had to be a doctor before crypto hijacked me. So technical analysis. Now this involves the use of multiple tools, indicators to interpret what the market is telling us. Now there's also the fundamental analysis part, which involves the fundamentals of that asset. So things like the company's financial details, the financial performance of the company, news about the company that can move or affect the share price and different things like that. And then you have, for crypto, fundamental analysis, of course, is largely things like news, information coming from external sources that try to help you gain clarity or that has the potential to move the market. So give you an example. This last week we had America coming out and issuing tariffs. They dished it like like pack, like takeaway packs, give everybody their share, and then the market started bleeding heavily. Crypto stood well at that time, even though now it's beginning to catch up to what has been happening across board. But fundamental analysis, they're usually external influences on the market. Yes. And then you have quantitative analysis. I'm sure most people don't know about this one, quantitative analysis. Have you heard about this one before?
Not.
Interesting. So this one involves the use of statistical tools to interpret what the market is doing. Yes? And then of course we have price action analysis. This is PA. Now, these four tools can be used to analyze what the market is doing and then take decisions. Yes? Generally, I think this is the most popular one. This one, almost everybody knows about this. This one too is fairly popular. And I think this one is not that popular, but it's also very useful. Yes, I'm sure you've heard things like 21 moving average, yes, 100 moving average, and things like the moving averages and stuff. Moving averages are statistical tools. I hope you know that for those who did or who know about statistics. Yes? So that is on one side. Now, price action analysis, which I have found to be a little bit more real time in terms of now technical analysis, most of the indicators are lagging, which means they are not real time. If you use RSI, for example, RSI is not an instantaneous tool to read the market. Sometimes it's lagging a bit. Yes, the same thing with all the other indicators that you're used to, Bollinger Bands and all those other ones. But with price action analysis, you're looking at the history of price and the behavior of price to determine what decisions to make based on that. Yes? Now, which means that there's a way price behaves that will give you confidence that this is probably time for price to reverse, and vice versa, right? Which means when you look at the behavior of price, you can have an idea of what the market is trying to do. Yes? So in this session, we are going to focus more on price action analysis. I'll try and help you understand a few concepts related to that, and then we can then put it all together by going to a live chat to see how this all comes together. Okay? There's a high chance that we may not be able to cover everything today. Maybe we'll do it in a series. But if we all paid attention, there's a high chance that you would understand the flow, and that will help you better, read the market going forward. Now, one of the things I need to point out before I continue is that when you are deciding to read the market, the first thing you need to purge yourself of is your bias, which means you need to take out the agenda that you're going to the market with. So if you have, say for example, most like a newbie, anytime a newbie opens a chart, they want the price to go up. Is that not so? Am I lying?
No worse.
Every time a newbie opens a chart, he wants to see price go up. Unfortunately, the market doesn't work that way. The market works both ways, which means price goes up and price comes down. But there is a behavior of price around certain levels that gives you the idea that something is going on here and something might come out of it, right? So we'll look at some of the things that we need to pay attention to that will help us to have an idea or an insight into what is going on, and then of course be more open-minded when we go to the chart. Okay? I hope you've taken down these 4 parts. Yes?
Yeah, boss.
All right. So price action analysis. Of course, just looking at the name, you can tell what this means. It means that we're analyzing based on what price is doing. Now, what are the first set of things you want to see when you look at price? First of all, you want to look at the structures that are forming, right? You want to look at the structures forming. You want to look at candle formation. What's going on with the candles? Yes? Is that not so?
Yes, boss.
You want to see whether you are having a, what's the best way to describe it? Whether you are having a momentum move or momentum move means a strong impulsive move. I'll show you all of that on the chart so that you can better understand. And then you want to also know what is, let me see. Okay, so you also want to know what the chart, what the levels, yes, levels are on your chart. Okay, but before we go into all of this, let's first of all look at what are the, okay, so I talked about structures here. What are the type of structures that you have in the market, right? This will bring us to the first thing we need to understand, that the market always has or always moves in three phases, right? Let's say phases in the market. I hope you are seeing my handwriting. So we have the first phase, which is the bullish trend, right? Is that also? This is usually, price moving up. Then we have the bearish trend, which is, of course, the opposite of the bullish trend. Which is usually price heading down, right? And then thirdly, which is usually where most people get, what will I call it? This is usually, we can call it a trend. Most of the time we call it a, what do I call it now? Usually we can call it accumulation. Accumulation stroke distribution trend. This is not actually a trend because it is usually price moving sideways. Yes? Do you get this? Let me use colors so that it's easier to, so these ones are heading down. These ones are heading up. Then of course this one is mostly, just sideways. Now I'll try and explain each of this, in the best way I can. I'm trying to make this as layman as possible. Yes? In a bullish trend, we know, almost all of us know what a bullish trend is, right? Price going up, that's when we brag about price. Yes? Buy and rest, buy and sleep, buy now, enjoy later. You remember all those statements you used to say to yourselves when the market is going up, right? Just buy and keep. You remember? I don't forget. Just buy and keep. That's in a bullish trend, price is always pushing higher and higher, which means there's always going to be a series of, up moving structures. We'll see it on the chart, but we need to first understand the concept before we go to a chart so that you can see what I'm talking about there. Okay? And a bearish trend is the opposite of that. Price is always going down. I'm sure in the last couple of weeks, people have experienced that. In fact, I think in the last couple of months, apart from when we rallied before Christmas and into the new year, and then after that, it's been bloody since then. Now, accumulation and distribution, this is usually where price plays most of the time, right? I always say that price ranges more than it trends. Usually, these are the three trends you have in the market, yes? But this third one is not usually referred to as a trend because it's more of a range of sorts. These two can be, of course, trends because you can have strong moves in both directions. But in this case, price is usually trapped within a particular region. So you have price, just hovering within a range. Do you understand this?
Yes, boss.
Okay. But somebody is asking, what's the difference between accumulation and distribution? Now, accumulation usually happens at the bottom or at support in a, so for example, when I will show you that on the chart shortly. Accumulation usually is where so let me before I come back to this, let me mention the two major or the major participants in the market. Yes, who can tell me the major participants in the market?
The retailers and sharks or ETF.
Is it a shark? Not be only shark. You have retail, which is of course you and me. They are the guys, small guys who bring money into the market. Then you have institutions. Sorry, institutions. These are, of course, big investment banks and other players who have big money to move the market. Yes, this one has more numbers. That's in terms of quantity. It has more number of people. Yes, but they have less money. I'm sure you know why. Right? This one has less people. Okay, I think more people. But they have more money. So, in your honest opinion, which of these two do you think will move the market?
Institutions.
You say what?
Institutions.
Institutions, good.
Institutions.
So, institutions, how can we identify institutions? Would you say an exchange is an institution, for example?
Yes, because they have a
I
lot
think
of
they are
money.
under
Yeah.
retail.
You say what?
I think they have a lot of money and
Yeah, an exchange is an institution because they are like the providers of liquidity. Do you understand? For your retail and other exchange related trades. Yes? Then you have market makers. Do you think those ones are institutions?
Yeah, the institutions.
Okay. Do you know any market maker in the crypto markets?
Elon Musk.
Elon Musk. Don't go talk this thing outside though. Elon
market
Musk,
makers.
báwo. Elon Musk is not a market maker.
Michael Saylor.
Market seller is not a market maker.
Wow.
Have you heard of winter mute before?
Yeah, I've heard of it.
Okay, so you see, you people are not doing research, and you say you are traders. You people just the. All right, so you have market makers, and then you have, of course, bigger structures like ETFs, which, of course, recently just came to crypto, right? Now, each of these entities have large amounts of money. They're majorly the source of liquidity in the market. Now, what does this mean? If you understand that these are the guys with the real money, then I think if you want to roll with the big guys, you have to track what these guys are doing. True or false?
True.
So that means, therefore, that whatever these guys are doing will determine what the market is going to do next, right?
Yeah.
Is that not so? Now, how many of us have been tracking what these guys have been doing? Some weeks ago, when we had a session on crypto, please mute your mic if you're not talking. When we had a session like this, I mentioned that there's an observation that the ETFs in crypto were selling off their Ethereum positions, right? And I saw that they were also buying back their BTC after selling off some time ago. Now, what does this imply? You will notice that since then, Ethereum has shown a lot of weakness, while Bitcoin has been a little bit strong, at least relative to the general traditional markets. Is that not so? Now, that's a typical way of looking at the money flow. You want to know what institutions are doing, what are the big guys doing, because that will give you a clue as to what and how to position yourself as a retail. Remember, I always say that the retailers they're the last to know anything. So if news comes out tomorrow now, trust me, some guys don't know before that time. Do you understand what I'm saying? And that's why you have to, as a trader, you have to research. You have to always be on the lookout for information, especially the ones, affecting your industry. Do you get what I'm saying? So if we say institutions are the guys moving the market, then it therefore means that when we are talking about accumulation and distribution, we cannot be talking about small players, right? Shey you where you want buy $2 of Bitcoin, now we go say you want accumulate Bitcoin. Do you get what I'm saying?
Yeah.
Don't feel insulted. I'm just showing you how small retailers are. Look at Michael Saylor buying billions of Bitcoin as his company. His company strategy has been buying Bitcoin. They have almost 500,000 Bitcoin position at the moment. No, I think more than now. Yes. An individual will hardly be able to do that kind of thing. Do you understand? So that is why when you hear the word accumulation, or distribution, it is usually a sign of something. I would explain both as simply as I can so that you can understand it. Now, for accumulation is usually something that happens after a market has rallied and is consolidating or ranging within a particular point. Now, when you have an accumulation range, you have something like this, right? You have price ranging within here, right? It stays within here for the most part. Sometimes you can have the range expand a little bit where price enters and still continues like that. Sometimes you can have it expand downwards. But why is it important to know the difference between whether it's an accumulation or a distribution? What are the differences? Now, accumulation happens where big buyers are buying. This is a buying activity. Yes? So instead of them taking big money and go and put into the market at once, which will cause a huge spike in price, yes, they will go and put small orders. Yes? So you will notice that sometimes when price is in accumulation, the volatility is usually smaller. Do you get? So price usually stays within that range, but the volatility within that range gets smaller and smaller over time until you have a range break. Of course, after a range breaks, what you get next? You said what? Sorry.
Them talk say call will end in 15 minutes.
15 minutes, okay. We don't reach 1 hour now.
I know it was so yeah, almost getting there.
Oh, okay. I know, Allah. We'll just start over again. Okay, so as I was saying, in accumulation range, price stays within. I will show you on the chart some of these things. I just want you to understand it first before we go to a chart. Because I know once some people see charts now, they don't throw away some of the things where they know. So accumulation happens at the bottom of the market. If you don't remember any other thing, remember this: accumulation happens at the bottom of the market, which therefore means that distribution happens where?
At the top.
Good, fantastic. Thank you for that. Are we still following? So if accumulation,
Yes, sir.
you will see why this is important to know, happens at the bottom of the market, which means big buyers buying little positions instead of buying at once and upsetting price. You will see why this is important, because once you are able to spot these things, you would be able to know when a trend is about to shift the other way, right? I will give you a very typical example recently in the crypto market so that you can have a mental picture of what I'm talking about. Now, accumulation usually happens at the bottom, which I said big buyers are buying in small bits rather than going to buy at once and cause big price jumps. Yes? So they're going to make sure that price stays within that range for as long as possible so that they can fill their bags. Do you understand? This is why they talk about, building your positions. Instead of just going and buying at once, you're building your position slowly. Yes, this is very similar to the 1/4 formula that we used to talk about, 1/3, 1/4, which means that you are accumulating as price goes down, but you are also mindful of where. So usually the market movers are the ones who determine where this accumulation will happen. Do you understand? Which means your ability to see the pattern and join them to accumulate when they are accumulating will determine your profitability at the end of the day. Have I made any sense?
Yes, sir.
Yes, sir.
Now, distribution is the opposite of that, which means when price has rallied to a point, all that they accumulated at lower prices, of course, it will not make sense for them to just dump it like that. You get the point? So what they do is they will sell in bits. So they will set a price target within a range and then start selling off in bits. The difference between these two is that one is more volatile. Which one do you think is more volatile between these two?
I think the top
Distribution, yes. Because why? Oh, sorry. I was going to write volatile. So this one is more volatile usually than the other one. And the reason is simple. When prices is at the bottom, I'm sure you know that interest from buyers usually drops. Most people are not interested in buying. Do you notice that? That's why volume usually is low at the bottom of the market, because most people are not interested. They are afraid, or they're not just interested given the fact that price has dropped. Yes? But at the top, this is where people are getting excited that we are going higher. You get the point?
Yeah.
Now, I'll give you an example. When Bitcoin crossed 100K in January, yes, you will notice that after Bitcoin crossed 100K, we had a first dump to, I think, was it 92K? And then it went to 100 and something, came back down, went to 108, came back down, went to 109. You remember that? Yes? Do you guys remember that?
Yes.
Don't worry, we'll see it on the chart. But the volatility at that level shows that there was a lot of profit taking going on at that level. Now, usually when you see that kind of pattern, you begin to expect price to reverse at that point. Now, there are multiple reasons why this happens. Yes. So one of the things that will help you to quickly see these patterns is when you understand the levels that are on the chart, your SR levels, yes, which means support and resistance. Yes. Now, most of the time, we assume that support and resistance is just a single point. But most of the time, support and resistance, they're usually a region of price. Yes. You'll see that on the chart shortly. The region of price, which means price is playing within that band based on what has happened there or what is happening there at that moment. You see it on the chart shortly. But every time you see price begin to be very volatile after a rally, is usually sign that distribution could be going on at that level. And what usually comes after a distribution is a price down. Do you understand? Because distribution is a sell, there's more sell pressure when distribution is going on, which means most of the time it will price the market down. Accumulation, on the other hand, is the opposite of that. Do you understand this?
Yeah.
Because you will need this to be able to look at your chart and understand whether it's a distribution pattern or a accumulation pattern going on. Because remember, I always say that when you look at your chart, you always see things like this, right? You always see patterns like that. Is that not so? In a bull market, of course, this is usually rising. Shay? Is that not so?
Exactly.
Don't worry. We'll see that on the chart. Let me not confuse you. But you get the idea that I'm trying to show you here. That when you look at a chart, the first thing you see is the series of candles forming a pattern, right? If you look far enough, you might see something that is rising or something that is descending. Is that not so? In a bull market, of course, price will be rising, which means you will have a series of, I will show you that on the chart too, a series of, higher highs and higher lows. Yes?
Yeah.
And if it's a downtrend, you will see a series of lower highs and lower lows. So this is bullish structure. And this is a bearish structure. Have you ever thought about this before? So you're wondering that this is what typically is going on your chart, a series of higher highs or higher lows, or lower highs and lower highs and lower lows. You will see it. Of course, now it doesn't make sense because this is just the theory. But when you look at it on the chart, you now understand all the things that I'm talking about, right? But I need you to understand the basic concepts so that when I open the chart, you can begin to see all these things I'm talking about on the chart. And you will see how they all tie together, right? Because if you don't understand these basic things, you will go to a chart and most of the time, because you don't know what to start looking out for, you're going to either misinterpret the data or you will impose your own idea. And you know how that always ends, right? You always know how that ends, no be so?
Yeah, true.
You know they usually end well, right? So the idea here is to help you understand the flow so that it's easier for you to get the information that the market is offering to you on the chart, right? So now we have talked about accumulation and distribution. Yes. How do we identify this? We'll look at it shortly. We've talked about support and resistance, which is, of course, your SR levels, because you need to have a picture of that to understand why price is moving away from a particular level or holding a particular level or breaking down a particular level, right? And of course, this, remember when we talked about the things to look out for remember we talked about the things to look out for on your chart, right? Sorry, when you are making your analysis, we talked about, sorry, I'm trying to remember. The first thing we talked about was structures, right? Do you remember this?
Yes, so yeah, we have structures, candle formations,
Exactly. So
momentum movement.
structures are things like your bullish structure, bearish structures, accumulation, and all that to help you understand what is going on. First of all, of course, your candle formations, we are going to look at that on the chart now to see how all this comes together. So let's go and look at the chart. But now you understand first and foremost that the market is just in a cycle, right? And that cycle is a series of three things. Yes? So the market is always in a cycle. Yes? So you have bull, you have bear, you have accumulation, distribution. This is the cycle. The market is always in this cycle, which means for a moment you have this, sometimes you're going to have this, and then sometimes you're going to have this. It's important to be able to tell what structure is forming on your chart so that you can know where to position yourself, right? If you look at it that the bulls are in charge and you are instead short selling, what will happen to your positions? If you're bearish in a bullish market, what will happen to you?
Losses.
If you're bullish in a bearish market, what will happen to you?
Losses. My loss.
Losses.
Exactly. So loss seems to be the logical outcome of being on the wrong side of the market, which therefore brings us to this part of what I want